Welcome, everyone. Hello to our community of founders and builders and startup enthusiasts. We've had a lot of engagement across all of our social channels, and many participants wanted to dive deeper into some of the topics we've covered. So here we are today to answer some of those most relevant questions, drawing from the topics that we've already covered in the webinar series. So without further ado, let's go. First question. Everyone seems to be launching an AI startup. What makes investors pay attention? So of course, the days of just showing a product as an AI wrapper or something that has AI buzzwords around it and simply raising money with that are disappearing. Investors are wanting to see a deeper understanding of AI, a deeper application of AI, and of course, a defensible application, what can be protected or copyright. And essentially at the early stage, they like to see founders who are deeply knowledgeable, sometimes immersed within the industry or the problem they're trying to solve, and of course, passionate about it. So I would say most of the time, it comes always back to the founding team. Products are fantastic, but investors back people first. And so they want to see those founders who have found that real key problem, maybe even a niche problem to begin with, and found a way that technology can help solve that problem. But of course, they want to make sure that the problem is big enough to justify a venture capital backed business. Even the best technologies and ideas, however, can fail and do fail if the team around it cannot build a sustainable and scalable business. On to question 2. How much traction is enough before seeking investment? That's a really good question. And founders and startups often have this question as they're raising not just their first round, but thereafter. And there isn't really a single benchmark or metric that answers, because every single startup can be different. It depends on the stage you're at. But for very early stage startups, traction can often mean having a version 1 of a product, having a few pilot customers, or strong validation from potential users. And this can look very different depending if you are a B2B or a B2C startup. Many founders sometimes think they must have thousands of customers before speaking to investors, but that's just not the case. Investors are often more interested in quality rather than quantity. And this is really important. Your first customers should be really getting a white glove service. They should be treated like your champions or your future champions, because they're the ones that are going to give you the best early signals of whether your product is going to solve their problem, how it's going to solve it, and help define your trajectory moving forward. So less can sometimes be more. And founders should also focus on showing progress. So sometimes showing early growth is more important than the number of users. Customer interviews, proof of demand, maybe LOIs, letters of intent with customers or strategic partnerships. All of these are hugely important. Of course, the holy grail is showing recurring revenue. Customers that have purchased from you and continue to do so fundamentally shows that you have a product that people want. So I would say less is more, and always start talking to investors before you might feel you're ready is also a good indicator. Question number 3, which sectors are showing the most interest? Well, within AI, it's growing across all sectors because it's showing such a big momentum shift and such a big differentiator to the traditional ways of doing things. But certain sectors maybe are commanding more money. Healthcare, for example, remains particularly promising because, of course, it can help with diagnostic, patient care, operational efficiency. And healthcare is something that is universal no matter what market you're in. We all need healthcare, especially as the demographics is growing. So I think that's a market that's always been very, very targeted. But of course, things like cybersecurity, enterprise software, showing how big companies can work better with AI embedded into their product. These are all areas that are showing great great momentum. Can AI startups raise funding without generating revenue? Yes, is the simple answer. Many startups do successfully raise before generating significant revenue. And this is something early stage investors are often used to. They understand that building technology takes time. And if revenue isn't yet available, founders must provide other forms of evidence to show that the business has potential. This is how traction isn't always measured in revenue. It can be measured in lots of different ways. And investors often evaluate the strength of the founding team or the uniqueness of the technology or the size of the market. Customer interviews, pilot projects, etc. These are all early signals to understand there is genuine demand and that the team is capable of entering a market. That said, raising funding without revenue has become more challenging because AI has helped startups build quicker. So maybe an MVP used to take 6 months to build, not anymore. With AI, you can have websites, apps, etc. built within days. So this is where smart founders are actually showing that early traction from the get-go. And that's why it is becoming more difficult to raise without some form of traction, of which often revenue is the easiest to show. Question 5. What are the biggest valuation mistakes founders often make? I think this is where focusing on valuation is the mistake in itself, rather than what value creation you're showing. I think valuation can be a vanity metric. We, of course, see it on LinkedIn, on the news all the time. Startup raises X valued at Y. But essentially, the journey to a very long, sustainable, successful startup takes many, many years. And at the beginning, you should really focus around the customer and the problem and how you're going to solve that problem, rather than going out there looking for high valuation. In fact, a lower valuation can sometimes give you a better readiness to come into the market without the pressures of high valuation. Because a high valuation from the get-go can create undue pressure, undue expectations, not just to yourself and your employees, but to your investors and other stakeholders. I think unrealistic financial projections are also super important. If it's a market that you don't yet know, maybe don't expect to go from 0 to 100 in a year. Maybe find out what is the normal sales cycle, how long it takes to sell into your customers. And that's where, again, early validation and early research and proof point is super important, because you want to see what is the likelihood of scalability, not just from a technology perspective, but from a people perspective. Question number 6, will AI replace or create jobs? A really, really interesting question, which probably nobody knows the answer to. And my view on it is that overall, I think it will replace jobs. And we're seeing it already. AI can automate tasks, sometimes end to end. And history does suggest that that's where people will lose their jobs, in those repetitive, simpler tasks. But the nature of work will change, and maybe new roles, new industries will emerge. We're already seeing that in a way. There are now roles within AI implementation, governance, ethics, etc. So I think that's bound to happen. I think probably more worrying here is that the jobs that it will replace at the beginning will be lower skilled, maybe lower educated types of jobs. And we need to get that workforce ready to move into other roles. And that's probably a concern that I've heard and I've seen, and probably a concern that goes across boundaries and across geographical territories. What is this group of people that may have their jobs replaced first? What can they be doing thereafter to obviously provide for themselves, improve, make society better, etc.? What role does storytelling play? I love this question, because I think in the early days of fundraising, maybe you haven't got a product, Maybe you have version 1, which doesn't look or feel fantastic. Maybe you haven't got any revenue. To me, storytelling is everything. Because at the beginning, you're trying to go to investors, tell them about your vision, your thought process, what you want to build. And a lot of that will come across in your storytelling. Financial projections, product features, etc. They're relevant and they're important as part of your storytelling, but investors know a lot of that is finger in the air and a lot of it will change. So you have to, in a way, convince your audience, the investor community, before you have anything real to convince them on. And that is what storytelling is all about. Showing them that a strong problem exists, showing them there's a possible solution to that problem and how that can be monetized and how that can turn into a multi-billion pound company. It's a great exercise in communication. And great founders can often explain a complex idea very simple, make it compelling, and also add a fear of missing out element. I, as an investor, don't want to miss out on this opportunity with this particular founder. Storytelling also builds trust, which we mentioned in one of our webinars as key to the relationship, because you're asking for someone to take a risk on you and go on a 10-year journey with you potentially. So investors know why the team is uniquely positioned to succeed, and they want to see a combination of data, logic, but also a dream mentality sometime to how you're going to build this great big company. So be ready to tell your stories with passion, creativity, but authenticity and reliability. If I was to launch an AI startup today, where would I focus? Another good question. The truth is AI is everywhere. And I myself can be passionate about lots of different things and excited about opportunities. I think founders need to ask themselves, where do they see an opportunity that they might have knowledge of? Is it an industry they're working in? Is it an experience that they constantly are facing where they think there's a problem that can be solved? Is it something that they're passionate about? Because it's going to be a very hard journey being a founder, constant challenges, fundraising being one of them. So I always like to think about it rather than thinking of what are investors looking for, and let me try and fit within this tick box exercise, which is what it feels like sometimes. What is it that I can bring to the table from my experience, my knowledge, my current status, where I'm working, etc., and passion that can help me find that idea? And once again, like we said right at the beginning in the first question, how can I use AI in a deep way, not as a layer or wrapper where it's maybe, sure, helping the business in some way, but it's not as protected, it's not as defensible, and maybe investors will look at it as something that isn't at the top of their list to invest in. So I would say focus on problems, focus on what you know, focus on passions of yours. Doesn't mean you can't look outside of those, but sometimes some of those early problems are maybe closest to you and what you know. How important is proprietary data in AI businesses? As we just said, businesses that have small elements of AI are finding it harder to raise, harder to defend against competitors. Proprietary data is actually one of the most valuable assets that an AI company can have. In the age where data is all around us and LLMs and ChatGPTs are giving us data at its fingertips, proprietary data can actually create a very significant competitor advantage. Not just in terms of what you show customers, but also what you're training your models on. The competitors can't simply replicate. But it's not just having a large set of data that's going to give you a differentiator. They care about the quality of data, the relevance of data, and maybe the exclusivity of data, which is why we're seeing vertical AI solutions. For example, companies within sectors such as healthcare or legal, where they have really strong proprietary data that they are taking in exclusively and training their models on. which means what they can offer their customers has a level of premium quality to it, rather than generic information. And investors will often ask, where does this data come from? Can competitors access to it? Can they buy it later on? So proprietary data can really provide a very defensible strategy, improve accuracy, create barriers to entry, and therefore it's one of the pillars that, if you can get into your business, can really drive a strong business fundamental that helps investors value. What separates successful AI founders from unsuccessful ones? I think this is a difficult question to answer. First, I would say we are in the early stages of AI. What defines a successful founder to a non-successful one? It can feel immediate, but actually a lot of these founders are on an early journey. Maybe it's their first journey, and there's going to be a lot of ups and downs. So it's very difficult to say from now who are the winners, who are the losers, who are the ones that can show they can build AI companies, because it is a journey. However, we do see some kind of trends, let's say. And I would say successful AI founders are not necessarily the most technical always. They might have technical people in their teams, but they are the ones who are able to execute consistently, adapt quickly, and stay absolutely focused on customer needs at all times. They understand that building a business requires more than just technology. Great founders spend time listening to customers, especially in those early days, refining their products, perfecting, responding to market feedback quickly, and they build strong teams around them that cultivates that culture of innovation, customer focus, and accountability. I would say most of them, without fail, they might not be the best at what they do, but they are probably near the top of the tree when it comes to resilience and being able to navigate setbacks. And you will hear investors come back to this every time, that their best founders have had setbacks all the way, and probably still are. And even though we see the headlines of annual recurring revenue targets being hit, valuations going up, raising huge rounds, what happens in the back can sometimes be messy, and will involve daily or weekly ups and downs. So founders that are able to deal with constant challenges, hurdles, setbacks are the ones that will be most successful, not just in startup life, but in other things as well. Less successful founders can therefore be focused on technology, can sometimes let those negative feedbacks hit them harder. And often investors will look for those leaders that can just balance vision, execution, emotional intelligence with what they're about to embark on. But ultimately, the ability to learn, adapt, and behave consistently, because it is a consistency game, whether you're building a product or trying to sell to customers, is what investors see as a success for long-term building of startups. And I think final question of today, and again, a very important one: how can founders build trust quickly? Trust is a key word here. You are asking investors to hand over their money, but also come on a journey with you for X number of years. A journey which will be great, but also be difficult. So trust building from day one is very important. You could build the most compelling case for investment, but if the investor doesn't trust you, your team, or the way you're storytelling, they will unlikely to ever invest in you. And therefore, you have to show this from day one. How can you do that? Show them that the information you're giving them is based not just on your views, it's based on research, it's based on credibility. When they confront you with a challenge or disagree with you, show them that you can take that on the chin and come back with an answer. Continuous communication, even after the first call, showing feedback, showing reply to certain questions they've had, shows them the kind of person that they're going to be dealing with. So if you promise something, deliver it. And I think honesty throughout and consistency is absolute paramount. And therefore, founders that communicate with updates, stick to their commitments, and follow through on promises, even as simple as I will email you some information after our meeting, help build strong relationships from the get-go. And trust is rarely built through one single meeting, as we know. So it is that consistency of behavior with your investors that will help develop a long-term trust relationship. And what I would also say here, even if the investor does not write you that check at that moment, if you've built trust and credibility, you can always come back and speak to them at another time, whether it's for your existing fundraising or even a future one. And that's why building that trust is so important. So I hope this has been useful. We wanted to cover a breadth of questions that we've seen coming in. Thank you so much for joining. Feel free, or please do, send us more and more of your questions, and we'll hopefully have more of these Q&A sessions to come. In the meantime, continue building and creating amazing technology.